Hi, everyone. As Shartia just said, I'm Sarah Ponczek. I'm a markets and ETF reporter in New York out of Bloomberg. So this is going to be ETFs and their place in your portfolio. So thankfully, we have three great panelists to walk us through. We have Shannon Saccocia. She is the CIO at Boston Private. We have David Perlman. He is an ETF strategist at UBS Global Wealth Management's Chief Investment Office. And we also have Tom Staudt, and he is the COO over at ARK. So, Shannon, I really wanted to start with you because you have kind of been a part of the evolution of ETFs from '08 to now. So maybe give us a sense, walk us through how your use of ETFs has really evolved over time and how you even consider implementing them in your guys' portfolios now.
Sure. So we were traditionally, I would say, an active management shop, fundamental, really looked at the universe of managers that were available sort of pre-08 as being, kind of looking at team, process, philosophy. And with the advent of ETFs and really, kind of the first foray being into passive, they weren't necessarily something that we thought about initially incorporating into our portfolios. So I would say that I'm a bit of a convert to the ETF world. And what we've seen is that, as the markets have continued to become efficient and as our client base has expanded, what we've determined is that there are a number of different ways to implement. And so how we think about utilizing ETFs is really we start with our high-level allocation. And we say, what is the exposure that we're trying to garner? And then we determine the best way to garner that exposure and whether we want to do it in an active way or a passive way, and then what type of vehicle to do that, because now obviously with active ETFs, you can do that through ETFs as well. And so for us, it's really not sort of starting at the product level. It's really starting about the idea and the exposure, and then sort of determining, seeing in the universe if there's a way to find that fit. And ETFs have really expanded that because there's so many different ways to slice and dice the world from an investment perspective now. So I would say that my experience has been a little bit different than maybe other folks have, because we really started as a mutual fund and SMA active management shop and have found that over this trajectory that ETFs have become an increasingly important part of what we do.
So you mentioned active and passive ETFs, and I think sometimes people think of ETFs, they just think of passive investments. So David, you're constantly looking at different products, really slicing and dicing how they work, what to look for. When you think of the passive versus active space in ETFs, can you kind of explain to us what do you look at to figure out if using an active ETF is really worth it as opposed to using a passive ETF that might be cheaper?
Sure. So the ETF market has come a long way. So if you look at where the assets are, for active ETFs, it's still only about 1.5% of U.S. listed ETF assets are in active. Over 100 ETFs. So it's a limited universe. About 75% of those assets are in fixed income. So if you're looking for active ETFs, there are solutions there. There's a growing number of them, and we expect growth in that market to continue. But for right now, especially on the equity side, there's really a limited opportunity set to implement views in an active way within the ETF market. But what we also have is about 12% of the assets are in smart beta ETFs, and most of these assets are in equity products. So with the smart beta space, it's passive because it's designed to track an index, but what you have are the active tilts are coded into the index methodology. So that the index itself has an active objective to try to beat that benchmark. So with these smart beta ETFs, it's another way that you can look towards sort of a more active exposure to try to outperform those traditional benchmarks. And so in terms of like how deciding between active and passive, I think a lot of it depends on the client's objectives and what they're looking to accomplish. If they're really focused on cost and just looking to get the market exposure, and it's tough to beat the low-cost beta ETFs that are out there. But if they're looking for ways to outperform, then you have to look at how much risk are they willing to take, can they stick with the strategy, and sort of really evaluate the different options that are out there to try to see which makes sense for their objective.
Tom, I want you to jump in. Maybe explain what ARK does for anyone who maybe isn't so familiar, because it is mostly an active shop, and then why is active the best way to go about what you guys do?
Sure, I think that it's, as you've heard from the other panelists, a lot for most people, I'm sure here in the audience, as well as most people in the financial services, when they think of ETFs, they don't necessarily think of active management, and they certainly don't think of active management in the equity space. I think the latest number I saw was that there's only about $7 billion in the U.S. markets in active equity ETFs. and ARK represents about 2.7 of that. And so it's a fairly small market. We're a relatively new shop, started in 2014, but everything we do focuses on active, equity, and in the innovation space, disruptive innovation. So actually I thought John's introduction of this panel, I felt like I was sitting back in the office listening to things with self-driving cars and drones and genomic sequencing and whatnot. But we think that there is, when you look back at the various evolution of the ETF space, it ultimately has been about democratizing the space. And we think the next wave of that really is active management in an ETF format, specifically in our point of view in the thematic space. And so we focus on very forward-looking trends. We believe that when you think about innovation, it's very difficult to index innovation because those indices are based on backwards-looking metrics. So rather, while passive certainly may have a role in an overall portfolio, when you're thinking about innovation, when you're thinking about trends that are taking place, those are inherently forward-looking. Those are where active management has historically, and we believe continues to outperform and to capture that alpha. And as many of the projections for beta are quite pedestrian looking forward, we think innovation, thematic, and an active equity brings that to the investor, a retail investor who may have 4 or 5 shares in an IRA, and they now can get that type of exposure that they couldn't get before, all the way up to very large institutions and sovereign wealth funds who are choosing to express their active management in ETFs, probably for the first time in the equity space.
What are the most successful ways that you do see investors using your products and putting them to work within a portfolio?
So we're a shop that focuses solely on disruptive innovation.
Right.
So we're certainly in the aggressive growth space. We're not we don't have a full suite that's covering all of your style boxes. So for us, it's really about giving the investor choice of how they build their overall portfolio rather than trying to force fit them into some model or give their advisor that opportunity to have flexibility. And what I mean by that is we're a very benchmark agnostic shop in terms of how we manage. And so different advisors, different strategists will use us in a different way, will think about us in a different way. And so we see a lot of it certainly in a satellite type approach. It's probably going to be paired with something that's more passive, more core. But we also see, because there's a very low correlation in both an overall sense and a relative return sense to even other growth products because of the part of the market we focus on, that it certainly can fit in terms of an equity, a growth equity sleeve as well.
So Shannon, I want to turn to you. On the bit of thematics, is it something you guys are currently using? Is it something you guys would consider in the future? And would it be in the form of a satellite type product?
Yeah, I think it's a great question because it's something that we grapple with internally. We still have, we really have sort of a very open toolkit that we can utilize with our clients. So we have fundamental equity strategies that we manage in-house. We utilize external product. And one of the things that we found is that as part of our overall asset allocation effort, we are starting to talk more about themes. And, it's difficult for me to task my internal equity and bond teams with, sort of deviating their process in order to garner this exposure that we as a team like from an asset allocation perspective. And so I do think that being able to express perhaps more efficiently some themes that we're interested in, I can see us utilizing ETF products. Because it's the same thing on the mutual fund side, right? You're hiring a manager because they have a view of how they want to run their portfolio. So, selling in and out of a mutual fund manager when maybe they, decrease their disruptive technology exposure, that's not really ideal for us either. So I can see this as being a way that I think ETFs can play, a different role than maybe they have historically for shops like ours.
Right. And David, on top of everything that ARK does, there has been a proliferation of some thematic products out there on the market. So if someone's trying to look through and they have this idea that they want to express somehow on disruption or innovation and the future, what are the elements that one should really take into account when trying to decide what is actually the right one for them, the right one for their portfolio?
Sure. So there's obviously been a huge amount of issuance in the thematic space. Issuers are looking for differentiated exposure at this point to really try to separate from the top issuers in terms of assets. So when you're looking at thematic ETFs, I think there's a lot of interesting areas where you can see a clear path for growth in terms of the industries, especially within, say, disruptive technology. And within wealth management at UBS, we have themes around like enabling technologies, disruptive innovations. And what you have to do is, just because a theme is expected to grow, doesn't mean that it's automatically going to translate into good investment returns. So it's something where you have to be mindful of what is the portfolio of companies that you're buying. Sometimes these more narrow themes can have a lot of volatility, so you have to be willing to stick. You have to be willing to stick with these themes for the long term and to ride out the volatility. And then to really create an ETF around a theme, you have to have a certain number of companies. You need a certain amount of liquidity to be able to build a portfolio and facilitate all the creations and redemptions and asset flows. So in some cases, you may not be getting pure play exposure to the theme, especially when it's a newer industry that's being targeted. So you want to look at the portfolio of companies that are being held and see if you can determine, all right, what amount of revenues are actually tied to this theme. Are you getting pure exposure? If you're not getting pure exposure, what other companies are being included to really make the ETF feasible? So if you're investing really early in a theme through a thematic ETF, it could be that the exposure isn't that pure. It could improve over time, but you have to make sure in the near term that you're comfortable with the ETF and the portfolio of companies it's hold, and what's going to really drive the return of the companies in the near term. And then just being mindful of any sector tilts, country tilts, concentration to certain names, and you also want to take that into account as well.
How do you see fees playing into this? When you look across the ETF space, do you constantly see money just going into those products that are the cheapest products, or do you want to really look at past performance, and do you actually see the money going to those that do have good past performance?
Yeah, and fees are a huge driver of flows. Most of the flows are going into lower cost products. Just going off memory, so the stat may not be 100% accurate here, but I think last year is about 70% of the flows went into ETFs with expense ratios of 15 basis points or less, or 20 basis points or less. But in general, low fees are really taking in all the assets. And when I'm looking at ETFs, I don't really spend that much time on fees. It's pretty low down on the list. If you're looking at 10 versus 15 versus 20, and ultimately the difference in the index methodologies will, it's going to drive a lot more of a difference than just simply the small change in fees. And when you get into the thematic products where you're getting differentiated exposure, again, an aggressive growth strategy, if it's 70, 80 basis points, the strategy itself is going to more than make up for the difference between what you can pay to get the S&P 500. So fees are, unless you're looking at something that's tracking the same index or something that's very, very similar, fees are generally way down on the list in terms of what I look at. And you just want to make sure that what you're paying for is, you're getting the value out of that. You don't want to pay an active fee for a product that doesn't deviate from the benchmark that much. To the same extent, you don't just want to focus on how different it is, because if you allocate a lot to a high active share manager that's not doing well, it can do a lot more damage than a closet indexer. So yeah, fees are important in the long run, but in terms of selecting products, it's pretty low on the list.
Tom, for you guys, when you guys are creating products or going back and reassessing what your products look like, what the costs are, the holdings within, of course, because they're actively managed, what is the most important there, or what really resonates with those who might be considering using one of your ETFs?
Yeah, I think that the concept of fees is really interesting, because whether you're talking to an advisor or even to a media at large, regularly when they're assessing the fees at ARK, they're comparing against the broad swath of ETFs. And I think that that's misleading, really, because what they really should be compared to on an apples-to-apples basis is other actively managed mutual funds. And so in the thematic space, or any active space, really that's more of an apples-to-apples, because it's the exposure that you're getting. It's the investment strategy that ultimately you're buying. And at least in our case, you're typically looking at fees of about half of what it would be in a mutual fund format for the investor class. I think it's also really interesting in the thematic space particularly, because what we've seen is that thematic investors have been able to at least hold it up to this point, a little bit higher price point. They've had a little bit more of a ability to command price. But when I think about active versus passive, a lot of what's been driving active versus passive holistically, looking back, was a comparison of fees. And a lot of the reason that active underperformed in the cases that it did is that fees caused them to underperform. When you look at the thematic ETF space, though, the passive products actually have higher price points than our active management does. And so in this case, you're actually able to get active management for a cheaper price point than passive products in thematic ETFs. And I think that's a really interesting development, because Certainly, it's ARK's point of view that when you're thinking about a very forward-looking segment of the market, something that almost by its very definition is what is the runways ahead, where are the inefficiencies. David correctly mentioned that these are not always the most pure play. So you have to continuously evolve. If it's a set index, trying to replicate a thematic space in a constantly changing, especially when technology is involved, space, are those how they crafted those partial exposures? Is that going to continue to be the case? And the argument for that might be, well, if it's cheaper, then maybe in the long run that's okay. But in reality, in the thematic ETF space, very often active is actually cheaper than passive. And I'm not sure that that's the case in very many other segments of the market. So I think it's, the way we look at it is that in this particular case, you can have your cake and eat it too. You can get that exposure. Yes, these are changing. These are rapidly changing spaces. But I think that's an argument for active, not against active. And as we start to enter a macro environment where the correlations of the sectors, of the asset classes, start to decouple and start to spread out a quote-unquote more active market, while at the same time we have a number of innovations. I hearken back to the speech that introduced this panel. So many exciting things, so many technologies are taking place. The fact that GICS had to add a sector speaks to that. In that environment, I think investors actually benefit from this evolution in the ETF space to be able to have access to strategies like this that perhaps before they would either have to have a separate account or a mutual fund.
Shannon, I want to bring it back to you because you said you use them to express ideas. So you have this idea. What really comes next? Because you have this idea, and there are so many different products that you could use as a tool. So
Right.
How do you decide which is the right one for you?
Right. I mean, I think that's, I do think it's fairly critical. I mean, one of my colleagues is here with me, and she and I would agree on this. It's not just, you can't just screen out of Morningstar and find what you're looking for. So you really need to look at the underlying exposure. You need to look at how the ETF is constructed, how it's been changed over time. I do think that, to be honest with you, if you're expressing a specific view, it is a little bit easier to do that in an ETF now than it is on the mutual fund side. I would say that I would take the counterpoint to the fee argument. We actually do spend a lot of time looking at fees, and it's not just the expense ratio, it's the fees to pay to transact at the different custodians. We're large enough, we use multiple custodians, so that really does play into our decision making as far as being able to affect a theme, especially if we think it's one that we're going to be in and out of over the course of, say a year or 18 months. And so I think that one of the things that we try to do is think about, utilizing our partners in the ETF space as well, because obviously, there's a lot of different ways you can screen out things, but just reaching out to our partners and saying, hey, do you have something that expresses this view, and can you give me some examples? So I would say even more so now with the proliferation of products in both the ETF and mutual fund space, the partners that we have at the different firms can really help to, and it might not always be the best fit, but we find a lot of benefit in reaching out and saying, we're looking at this. Do you guys have something that sort of expresses this theme? It also helps us with our clients. We have a lot of private clients. They have a lot of questions. They'll hear about something in an article in Barron's or in the news, and they'll be like, hey, I heard about this. Is this really investable, or is this something that's a one-off? And as many of you know, sometimes it's a one-off thing that has no liquidity and isn't really investable yet. But that we can reach out to our partners and say, hey, my client has some questions about this. Can you give us a little bit of information? So in that case, I think it's more than just going onto a database. I think it's utilizing the context that we have and being very prescriptive about the exposure that we're trying to garner. Because I do think sometimes you look at something, you're like, oh, this is great. Like, this is really interesting. It's not really what we're trying to express, and it might be redundant to something that we're already doing. And so trying to be prescriptive and also trying to be really disciplined about just if there isn't something out there that's expressing that theme appropriately, we won't sort of half-ass it, I guess is the right word to say. So, very professional.
So you mentioned liquidity. How do you go about assessing the actual liquidity of a product? Because you could look at a name and be like, oh, this is a great idea. but there's no underlying liquidity.
Yeah, we do invest in some vehicles that don't have, if you go out on Bloomberg and just look at the the daily volumes, they don't have the volumes that I think most people would say, wow, that's a really liquid ETF. We're fortunate to have an in-house trading desk and access to capital market groups that can help us to determine the actual liquidity. So it's sort of like a checkbox thing. Like, it's really easy if you go out there and you're like, wow, yeah, tons of liquidity, great. It's not even a concern. But I would say if it's something that we do think is interesting and something that we could potentially use, we do have at $8 billion, we could affect a larger trade. So we will reach out to our partners and say, is this, how does this actually trade, and is this something that we would be disadvantaged in doing a larger trade in on any given day?
David, from your standpoint, looking across the universe, how does liquidity play into it?
Sure, and to Shannon's point, there's more than just the on-screen liquidity, and you can place bigger trades in ETFs that don't have the trading volume because of the ability to create and redeem shares. But I still think you still have to be smart about trading, and it doesn't matter if it's a small ETF or the large ETF. And for the longest time, we've been talking about concerns over liquidity in fixed income ETFs and ETFs that are thinly traded, and we look at two of the most pronounced ETF trading issues have been large cap U.S. equity ETFs, right? With the flash crash and then with August 24th. So, it just shows that even if you're trading the most liquid ETFs, you still have to be smart about how you trade, right? Avoiding trading around the open and the close, not using market orders, no matter what the underlying liquidity is, and reaching out to your resources, whether it's an internal trading desk, whether it's the capital markets desk of one of the issuers whose product it is. So, for liquidity, I'm generally not concerned on liquidity because as long as you're smart about trading and you use your resources that you have available, you can get good execution.
So, Tom, from an operational standpoint, product development standpoint, how does this play into what happens at ARK?
I think that liquidity in trading is always one of the biggest topics that we have to have with advisors as they consider. Now, I'll note that my comments really specifically refer to the equity space because that's where we play. But you have to remember that at the end of the day, an ETF is really a derivative. It's a derivative of the underlying basket of securities that make up the ETF itself. And so if you have a liquid basket of securities, even if it's thinly traded, there's still liquidity in the name. Now, I completely agree, and I recommend most firms now have an ETF-specific trading desk that understand these mechanisms. But it's also important to remember when you think about traditional supply and demand, ETFs trade very differently than stocks, right? Stocks, there's a fixed amount of supply and demand adjusts. And in reality, in the ETF space, demand may adjust, but supply can also adjust perfectly both up and down in order to meet that demand. And so I second what has already been said here in that there's always more liquidity than what's shown on screen. We spend a lot of time from the product creation standpoint of going over what liquidity would look like before we bring a product to market. I think that you do investors a disservice if you don't consider their experience, the client experience, the customer experience for both the end investor and the advisor, if you don't think about that when you're building the product. Now, as an active shop, we have to work within certain parameters around that as well. But in terms of that liquidity, thinly traded does not mean illiquid. Now, there's always times when, yes, it's a benefit, it's helpful. So I'm not writing that off completely. But there's almost always more liquidity than what you see on screen. Market makers are typically willing to engage in those conversations, certainly of trades of any real size, and really think about what's in it, even if you're not trading it like what's in it. And so that's interesting. And I think the other piece of that is that people often reference the flash crash as relative to ETFs and relative to detriments and perceptions. And I think it's really important to tell you from the product side that the exchanges have done a lot of work, regulators have done a lot of work. Many of the issues that caused that no longer are part of the system. I think that there's still some structural reforms that can be made that would improve the process. I think our biggest frustration from a provider standpoint typically revolves around the open. The close is a little better from our standpoint than the open. So I would always recommend, regardless of what ETF you're using, not to avoid the first few minutes of the open. And if you think about it from the market maker standpoint, they have to have price discovery on everything that's in every ETF. So there's going to be a natural lag. And from a product sponsor standpoint, we want the client, we want the advisors to have the best experience as well. It's in our best interest for you to have quality execution. And so if there's ever questions, I would always recommend reaching out either to an ETF-specific desk, to a market maker, or even in some cases to the sponsor of the product itself, because they typically know their products better than anyone.
This is different than the flash crash, but we saw what happened back in February with some of the inverse VIX products. From your standpoint, when you're looking at risky products, there's 3 times leveraged products. How can you go about trying to use these? Do you stay away from them completely? What's the viewpoint there? I think you start with David.
Sure. I think the biggest thing for those products is understanding what they're designed to do. So a lot of the issues around the leverage and inverse space was just a misunderstanding of what the strategy was expected to do, right? It's not a buy and hold product that's going to give you 2 or 3 times or -2 or -3 times a return, right? Its objective is a daily objective. So understanding what that means if you're going to hold it for longer than a day and what markets where you can really get burned by that exposure is important. And the same thing that goes within, right, the shorting VIX future strategy where, those products have generally been restricted at UBS, and we've taken a lot of calls of people wanting to get involved because if you look at the return up until earlier in the year, it was phenomenal. But so not many people understood the risk involved with that strategy. We saw the same thing with oil futures back in the day. So it continues to come up over and over again. So when you're dealing with some of these more complex strategies, you really have to understand the risks involved, and that should help in terms of avoiding some of those outcomes.
I would say, going back to my comment previously, there are imperfect ways to express an idea. And so for us, even if we're really excited about the equity market, a 2x ETF or something like oil in the past, those things seem to us to be imperfect in their execution of the idea, and typically what we find is that they do become even more imperfect in times of stress, and so that is obviously not when you would like something to start to function improperly, and so we've stayed away from those, much to the chagrin of some of our clients as well. And I do think that with the expansion of the ETF space and the product structured space in general. I mean, you look at things like on the mutual fund side, interval funds and that sort of thing. There's all different ways to actually structure a 40 Act product right now. And so really thinking about what could happen and what the risks are when things aren't going perfectly, that's what we do spend a lot of time. And sometimes we stay away from things that seem like a great way to execute something in a day where there's lots of liquidity and a lot of buyers in the market. And so we do tend to be a little bit more conservative as it relates to those structures.
So we only have a few minutes left, but because, David, you mentioned it at the very beginning, smart beta, and that can often blur the lines between passive and active. And I know you do research on smart beta, on factors, how to really go about using them. What have you found is the best way to go about using factor products?
Sure. So we've done a lot of work in this space. And for factor ETFs, right, you can generally get single factors, or you can get products that combine multiple factors into one portfolio. And each have their own different advantages and disadvantages in the use cases. In general, we try to stay away from the factor timing, right? Trying to say when to be in value or when to be in momentum, and really suggest that our investors get diversified exposure to these factors. So we're proponents of factor investing. We think it's very challenging to try to time factors to generate outperformance. So we suggest just equally weighting exposure to the factors, get a diversified mix. And really set the expectations of the client. These factor products are designed to outperform, or attempting to outperform over the long term. So it's really controlling the behavior along the way and try to stick with the strategy, because there will be periods when they underperform. And I think the longer that you hold a diversified factor portfolio, the higher your probability of outperformance. And behavior is a huge driver of why some of these factors exist. So the last thing you want to do when investing in factor products is make behavioral mistakes. So really keeping a long-term perspective, diversifying your exposures, and then sizing in the portfolio to sort of meet your objectives and risk tolerance.
Last question, Shannon. I know you guys do assess and you look at your factor exposure. How do you guys go about doing this? And if you guys were to maybe complement using a product, how might that look?
So I would say we look at factors from a risk perspective. So obviously having a large chunk of our assets in active fundamentally based strategies, what we found over time is as we've done more quantitative assessment of those, we have some perpetual factor bets that we're taking in our fundamental process. And so to the point where over time those factors may continue to deviate from a performance perspective, we would like to mitigate some of that risk over time. So I do think that over the course of the next couple of years, as we become more intense in our quantitative analysis of our fundamental work, I do think that we'll probably use that from a risk perspective to mitigate things. Again, not going back to the fundamental team and telling them they have to change what they do, but thinking about it from a portfolio construction perspective and saying this is probably a bet that we don't want to be taking, for the extended perpetual period of time.
So that is probably, we have 10 seconds left, so all the time we have. Perfect. I want to thank our panelists for joining us. We'll be around if anyone has questions. Feel free to grab someone and ask, but really appreciate your time. Thanks.